Hey guys, Akil here. Welcome back to another Trading Edge video, the weekly video that I do walking you around the markets and sharing with you the top trading ideas that are on my radar for the week ahead. I apologize in advance. The voice is a little bit hoarse. I was at a track meet all yesterday yelling and screaming. We actually won, which is good, but now I'm paying the price for it. So just bear with me. Now, we're going to hop into the technicals, but real quick, I want to give you a little bit of an update on the fundamental side for you guys that may be new and don't follow on a weekly basis. We are still in a time of uncertainty in the market. We have lots of wars going on, but the main one in focus right now is the US versus Iran. And coming off a low liquidity holiday weekend, we have our US president saying pretty much that, hey, this war is probably going to last a lot longer than we thought it was. And this puts us in an interesting situation because that right there puts the market in what's called a risk-off type of mode, meaning that there is uncertainty, nobody wants to take risk, let's flock to the safe haven assets. So you got like the US dollar, the gold. I did a whole video on safe haven assets. You can watch that as well. But on the other hand, we also have predictions that, hey, we are still looking to cut our interest rates here in the US. So pretty much you have two different things. One is saying, hey, we should be looking at dollar weakness. The other one is saying, hey, we should be looking at dollar strength. And we are playing this back and forth game with whichever type of news comes out. So it wouldn't surprise me if that continues to happen as long as we get talks from each side about each of these contradicting things happening. Anyway, back to the charts because that's where I like to exist. We've got a lot to talk about today. I'm going to try to run through it as quickly as possible before my voice gives out. So we'll start here on the pound yen at a potential advanced pattern formation. This is going to be a potential bat pattern. Our starting point is going to be right here. This is going to be our X leg. This is going to be our A leg. And what we're going to do is we're going to connect the dots. We're going to draw a line from our swing low to our swing high right here. That is going to be my X to A, as I mentioned. I then want to take my Fibonacci retracement tool from that same X to A, and I want to measure what this retracement comes to. You can see that it comes to the 50%, but not quite to the 618, meaning I am going to be on alert for a potential bat pattern. Now, real quick, for you guys that were talking to Tier 1 members right now, I apologize, but for you guys that were in the Q&A last week, we did an awesome session on close enough patterns. We worked with one of our traders on creating rules for how do we handle situations where obviously this spike is very close to the 618, which would make it a completely different pattern that completes at a completely different spot. How do we have consistent rules for that? Should we have consistent rules for that? If that's something you're interested in or curious about, I recommend going back and watching that video. For me, my rules are black and white. Either it hits or it doesn't hit. This one does not hit, so it's going to be a bat pattern, and the entirety of the pattern is going to look like this. X to A, as mentioned earlier, A to B right here, B to C as we fail to extend higher, and then if price action were to come down to our 886 Fibonacci retracement, that will be the completion point for my D leg, and our zone of completion would go from that D leg all the way to the X leg. So for me personally, I trade advanced pattern formations with an aggressive limit order. So my limit order goes right on this 886. This would be a buy limit order. I know a lot of you guys sometimes get confused with what type of orders to put on. So I'm going to try to do a better job of explaining that. Maybe I should even write it down here. This is going to be a buy limit order right here. Buy limit. Meaning that if price hits that level, I am filled a buy. And then your stop would go below here. I won't draw it out, but this would be considered a sell stop because your stop loss is going to be the opposite, not stop. Oh, can't spell. Stop. There we go. Your stop loss is going to be the opposite of whatever you're doing. So this would be a sell stop order down here. And then your targets, which would be up here somewhere. We'll just do target 1, right? This is going to be, and I'm not drawing these on the scales, guys. I'm just kind of using this for example. This would be a sell limit. So remember, if you are buying something, you need to sell to get out of it. I cannot spell. I'm dying here. If you are selling something, you need to buy to get out of it. Yeah, there we go. So nice potential bullish bat pattern here. Next up is going to be the dollar Canada. Dollar Canada, you guys remember this one. We had a lot of things happening here. Just to give you a little bit of a recap. We had a bat pattern, and I say had or maybe have because technically it is invalidated because we passed the X leg. But if you're actually trading this, you're still involved because I would hope that your stop loss wasn't this close. But this was also from the last, month's worth of videos where we had the buying opportunity that we traded it from here up to there, then stopped and reversed and hoped that it was go down. It was a whole thing, which was actually pretty cool. So we're back on Canada, and I've got something else for you. I've got a simple pattern formation, classic pattern formation called a double top, right? Little IPD action, identify price is at a previous level of structure right there. We have not broken and closed above it, so there is no violation. If we were to go down to our lower time frame right here on the 4-hour, you would see that we came off this level, right? Pivoted here, and then came back up to retest it, giving us a nice double top. Now, here's the thing that always gets traders somewhat confused, right? So this black line right here, as I delete this arrow, is going to be the high of our pattern. And you're saying, well, Akil, we are trading above it, so isn't that going to count as a violation, and therefore this should not be a double top that I can take? Well, the answer is no, right? Because what happened is with this candle right here, we established a new high. So this would be the new violation point. And you can see that we never actually broke and closed above that level. So we are still, that level of structure still has its integrity, right? So we have a double top here. A price action came up. RSI went massively overbought, right? All this green junk up here means super overbought, right? And then we came down, we retraced off of it. We came back to it. We have a bit of divergence. And what I mean by that is you can see that our RSI is nowhere near where it was before. So lower lows here on our RSI, or lower highs, excuse me. It's a very nice double top situation. Now, if you're someone that is concerned with the price trading above structure, even though it hasn't violated, you can always wait for a 2618. And what a 2618 is a double top followed by a 618 Fibonacci retracement. And there's all types of variations you can do for it. But essentially what you need is price action to violate we just talked about this. You guys gave me terms for this. I didn't know what to call it. The valley, I think peak and valley, right? We violated the peak, or the inverted peak here, which would confirm the double top, right? Means, yay, price is doing the thing that we thought it would do. And then what you can do is you can take your Fibonacci retracement tool, drag it from the right top to wherever that violation goes. And then if price action pulls back, if you're following the rules, it's to the 618, but honestly, it could be anywhere from structure. You can look to catch that pullback on the way down. Speaking of which, for you guys that are, again, following the channel, you saw the video I put out a couple weeks ago now that talked about 3 ways to trade. Yes, we have a fancy name for this. This is a 2618, but what is it essentially? If we were to categorize this under the 3 ways to trade, right? There is breakout, there is pullback, and there is reversal. What would this be? Well, this would be nothing more than a pullback trade, right? If this is a pullback trade, right, entering right here as price pulls back and expecting to continue down, the 2618 is nothing more than this. Here you go. Add it to it, right? So you see it's the exact same thing. And if you guys are new, I recommend going back and watching that video. But I like to simplify my trading just because I think too many people make it too complicated to sell you stuff and make you believe that you can't do it, or maybe just because my brain is small. But what I've done over the years is I've classified trading into 3 main categories. And really, any type of move you see in the market falls under one of those 3 categories. And if there's another one, I plead for you guys to let me know. I'm not saying that to brag. I'm just generally curious as a trader. But what I found is that when I simplify that and understand breakout, reversal, pullback, it helps me understand a lot of the other complicated stuff out there, because there's so many different ways and things you can trade. And sometimes it gets confusing where it's like, this is a head and shoulders, and this is this, and this is that, and this is that. But I think if you master those 3 principles, right, because the advanced is nothing more than a mastery of the basics. So if you master those 3 basic principles, it makes it so much easier to understand everything else in the market, because you can kind of put it into perspective. So just my opinion. If you share the same opinion, let me know. If you think differently, let me know in the comment section. I'd love to see if I'm just the crazy person out there, or if I'm actually making sense to you guys. But It works for me, and selfishly, that's all that matters. Next up is the Kiwi. You see, we ended the week with a lot of dollar strength, and this is another one we've been stalking for a while. We also ended the week with a nice violation of structure, a lower low, lower close. Price breaks and closes below our previous level of structure. And if you're familiar with our IPDE process, the simple 4-step process that we use to stay consistent in the market so that we don't do weird stuff every day that we analyze the charts, if we can identify a break and close below, we can then predict, that's the P, that price is likely to continue lower. Now, here's the tough part. The second part of that prediction is if price is likely to continue lower, then where are we likely to continue lower to? And the level that stands out to me is this. It's a big stinking level, and the problem is that price is already in that big stinking level. So you may see this as a situation where we can say the move has been made. But we also know, and if you don't know, you'll know now, that there are two types of structure. There are inside levels of structure, there are outside levels of structure, and one is more important than the other. I'll give you a pop quiz, and by that I mean answer it in the comment section, because I've tried the quizzes here on YouTube and they don't really seem to work too well, or at least I don't know how to find the answers to them or like look at the results. But which do you think is more important? Pause the tape if you need time. The answer is going to be the outside level of structure. Now, with that being said, I am still a super conservative trader, so I want to take this whole consolidative level of structure into account. So if I want to see or confirm that this level is not as important as this level, there's a simple thing I can do. I can take my volume profile tool, I can measure it throughout the range, and I can see that, hey, you know what? We do have a volume spike at this first level just as much as we do at that second level. And if you guys remember, late last week, I put out a video sharing with you 2 trades that we looked at and how this particular tool in one scenario helped us to have a higher target projection, so get more money out of the market. And in the other video, it helped us stay out of a trade. Well, I don't want to say helped us. It caused us to stay out of a trade, which some may look at as a negative. I look at it as a positive, but it is what it is, right? There's a gift and a curse of everything. You want to just follow your rules. This will be one where it's like, hey, if you have the opportunity, if this thing pulls back right away, you can go down to a lower time frame, and you have the opportunity to ride it down, you may just want to be cautious about this level right here, 56.5. Maybe this is a target level. Maybe this is a level where you move stops to break even. But I don't think we should just ignore this level because of that spike. With that also being said, it shows that if we can violate this level, then we should be able to push down to this lower level as well, 56 even, another psychological number, pretty freely. So in a situation like this is a perfect setup for like a 2-target trade where we do have 2 levels. I do want to be cautious, so I would take one off here and then move stops to break even and protect my back end, so have no risk there. But then I would also have a secondary target here just in case we do make that run. So again, just another way where we can look at the charts, we can analyze it. We want to be detectives that gather different pieces of evidence so that we can make the most informed decision in the market and just put ourselves in not only the best position to trade, but the safest position as well. Next up is Canada Yen, and we've got a nice little head and shoulders pattern setting up, right? This is another classic / complex pattern formation in the market. We'll measure this down. First, let's just see where price action is at, right? Price action came, look left, structure leaves clues to a previous level of structure. So we can identify that. Identify price came to a previous level of structure. It held with a nice little double bottom down here, and then it retraced back up. And this little wiggle and jiggle that price made is a classic reversal pattern called the head and shoulders, where price comes down, it retraces back up just like in a normal trend, extends back down just like we would expect from this trend. It gives us a deep retracement, which is a little bit of a warning sign like, hey, wait a minute, this trend may be losing strength. And then we have a failed extension, right? So in a trend, we would extend again. We have a failed extension right here, and that ends up giving us this nice little right shoulder. Now, For validation of the head and shoulders, you need a violation of the neckline. If you are a horizontal neckline trader, then this solid line would be the level that you need to be violated in order to confirm the head and shoulders. If you are a slanted neckline trader, a trend line trader, then the slanted one would be it. One's not better than the other. It's all about your personal trading philosophy. My personal philosophy is horizontal support and resistance rules and trend lines drool, right? Taking you back to elementary school days when that was cool to say for some reason. So it's the horizontal line for me, but it ultimately doesn't matter as long as you're consistent in what you're doing. The question is, okay, well, so I know if I violate this level, one of these zones, whichever one you favor, then my expectation is that price is likely to go higher, right? So that's our prediction. The next part of our prediction, and this is important to understand, like, is it worth my time to take this trade, is if price goes higher, then where are we likely to go to? And this is where things get hard again, right? We have a consolidation level right here, and you can see it pretty much sits right on top of what our entries would be. So it's like, is it really worth my time to try to trade it from here to here, even if we pull back a little bit here to here, right? And the answer is probably no. But the next question is, okay, well, we have this big zone of, I don't know how many pips, I'll tell you in a little bit, of 45 pips. Where in this zone is price likely to go to? Do I project it to stop at the bottom? Do I project it to stop at the top? I always start at the bottom because, again, I'm a pretty punky trader. I don't know the word for it, but I'm conservative and scared and stuff like that. But let's bring in that volume profile tool once again, and let's see if that gives us any clues. Now, if you see our volume profile and you see this kind of red and green spiky point with this little dotted line coming out of it, that's going to be something called our point of change, which is a fancy name for the highest volume spike in that area. So if you are going to project a level where volume is the most important, that is a solid level right there. So what you can do is you can kind of reduce your zone and say, hey, maybe instead of just shooting for the very bottoms here at 115.10s, I'm going to shoot a little bit higher, either right in this zone here about 115.28s, or even right at that point of change at about 115.39s. And you can just see that opens up a lot more opportunity. Speaking of head and shoulders, we're going to do a few of these in a row now. We've got one happening here on gold. I thought we had something else on gold too. Nope, we have one happening here on gold. We'll draw it out again for you. Move down. This one's a really slanted one, right? Retracement up, extension down, retracement up. Our right shoulder right here, and you can see again if you're using the slanted neckline, this has been violated a long time ago. This candle right here gave you confirmation. So we've already violated it. You had really two pullbacks. You had a small pullback here, and you got another pullback here with a nice little inside bar, higher high, higher close combination. So we have a candle right here with a long wick to the downside, meaning bullish rejections. Put a little bull there for you. I don't know what sound a bull makes. Moo, right? Probably more aggressive than that. But that bull rejection. We then have what's called an inside bar right here. And that means that this bar completes completely within the previous bar. If you ever want to identify these things and shortcut it, just like search inside bar and you'll get a cool little thing that just shows you where they're at. You can't see because I covered it up, but boom, inside bar right there. Pretty much that just means an area of consolidation. But what we would expect from that inside bar is a breakout. And we see that right here. Now, I don't know which direction this happened in, but this is a cool method if it did break out to the downside first, called an inside bar false break. Let me just see. Yeah, so it looks like we broke out to the downside first and then went up. And this is a cool little false breakout strategy. I won't go into super details about it because you don't need to know about it, but you can read about it more in the book Street Smarts. But pretty much what they're saying is, or let me back it up some. Pretty much with an inside bar, you would put if you're trading a breakout strategy, you would put a buy stop above, right? Which means if price goes up, you would buy. You would put a sell stop below. That means if price goes down, you would sell. And whichever way it breaks out, you're filled that direction. And then the opposite order becomes your stop loss. So if it's filled to the downside, you're short, and then your stop loss is up here, and basic trading stuff. In the fake break, what happens is price breaks to the downside here, right? and then goes directly to the upside here. So obviously you take a little bit of a loss. So what you would do is, as this goes up, you would increase your stop loss order. So it's kind of like that stop and reverse thing that we spoke about, where you get stopped out of your selling order, so you lose money there, but then it puts you directly in a buying order as well, which gets you along the opposite direction. I regret explaining this to you because I try to keep these videos simple and I feel like I just complicated things, but it's a cool kind of classic strategy to use. Now, my opinion about inside bars are we should have a bias inside bar. So meaning in this situation, we should have a bullish or a bearish bias. We just shouldn't bracket them and try to trade whichever way they break out in. So you would never actually, you can still do this strategy, but you would never actually look to get short because you're just not in an area where you would expect a short. But that's a whole thing, and I'm gonna shut up now before that gets more confusing. If you have questions about it, you can just ask me, shoot me a message, or whatever like that. The fact of the matter is we have a higher high, higher close here. This is what I wanted to say in the first place on this retest of the head and shoulders. So if you are a head and shoulders trader looking to get long gold, ignore everything I said and just look at this as your pullback and a potential bullish entry reason here on gold. From the fundamental perspective, again, we're adding to the fact that the war may be going on for longer as of now. Risk off mindset in the market, dollar, gold, those are places you want to be when the risk is off. Next up is silver. And you can see we spoke about this a long time ago. You can tell because the head and shoulders on my chart is a different color back when my charts were white or no, blue. There we go. And pretty much the same thing is happening here. We didn't talk about where gold can go to. Oh, shoot. Let's go back to gold real quick. All right, so we can bring volume on here for gold as well. There's a few places we can look for. Obviously, if you're very conservative, look for just a retest of the highs right here. But you can see a few other levels that stand out. Our point of change, meaning the highest volume spike for gold, is going to be right up here. We also have another spike right at this level right here. This is the level I would personally shoot for. We got a nice psychological number of 5,000. And no surprise, we got some structure support right here, resistance, I guess you can say, consolidation, and then looking left. Right? Structure leaves clues right there. That would be the go point for gold for me. All right, now back to silver. Again, pretty much the same thing as gold. Head and shoulders pattern, validated the head and shoulders pattern, retraced, gave us the little inside bar thing, which I will not explain again because I am still regretting going through that and melting brains after saying I like to keep it simple. But same situation here on silver. The higher high, higher close was a nice buying entry if you're looking to get involved. And again, we can bring some volume in and just see, okay, where is the next place that this can go to? And we can see that we have a little bit of a void here before things start to pick up at about 80 bucks or about 82.5. So those are both going to be good levels to look for in silver. Lastly, as we speak about things that are influenced by the war, oil, right? Yay. Oil's been on a wild ride right after I told you what it would do many, many weeks ago and no one believed me, and then it did exactly what I told you it would do. Yep. I've been good with oil over my career. Trust me on that. So with oil kind of being in the forefront of the news and pretty much oil prices kind of fluctuating back and forth based on the Iran war and more specifically the Strait of Hormuz that we always talk about, we have an interesting situation here where oil is rising once again, but any type of deal or murmur that there's going to be an arrangement for that strait to be opened up should send oil prices back down to where they should be. And this is very interesting because we're coming towards the previous highs right here, which we refused to break around 116s up to 120s. And we're actually putting in, or we have an advanced pattern formation setting up here as well. And I think it's just interesting to see how these things set up because these are, thought of like voodoo and black magic by many people, but these advanced pattern formations are actually formed by the buying and selling habits of big banks. And I won't get into that because I've already melted your brain once, but that is a real thing. Anyway, this is going to be a bat pattern again with our X to A, swing high to swing low, looking like this. Our A to B coming up here. I'm drawing a head and shoulders. Sorry about that. Let's try it again. X to A, swing high to swing low. A to B coming up here to our 50% retracement, not hitting the 618. Our B to C retracing down here, and then our CD completion pretty much almost exactly at that structural zone I drew out, a little bit lower at the 886. So if price action comes to that level, you got a nice bat pattern completion. That's it for this week. Try to keep it shorter than usual, but if you want more, there's lots of content you should check out. A few videos I mentioned in the video. I'll bring them up on the thing in front of you right now so you can see what to watch next. And I hope you guys have a happy Easter. I hope you guys have a great holiday on Monday. And until next time, plan your trade, trade your plan. Take care.
Best in the game, invest in my name. Check no restraints, I'm obsessed with the pain. I ingest, I retain, assess and I change. Possessed by the thought I'll be free one day from society's restraints. Money, clout and fame, mud, disease, a plague. We all love to hate, have to play the game, have to make a name. All our insecurities are on. This is